Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The first quarter is over, and that means earnings season is not too far away. And companies are going to answer a lot of questions that investors have coming out of 2022 and into 2023. What has changed about the economy, growth rates, margins, cost-cutting measures starting to have a real impact on the business? One of the companies that has a lot of questions to answer still is Peloton. And so I want to ask 4 important questions that investors should be looking at as we head towards earnings. My name is Travis William. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my content and turn on those notifications so you know when a new video comes out. Now, the first question for Peloton is about the company's hardware. I have a bike behind me right now, and this has really been the problem for the company over the last couple of years. During the pandemic, when there was way more demand than they could actually physically fulfill, they were doing crazy things like flying bikes and components over from Asia to just deliver them to customers and get them on bikes and get them paying that monthly subscription. But they took a huge loss on hardware. Now, losing money on hardware is something that management has said that they will likely continue to do, but they want to cut those losses from astronomical numbers to maybe single-digit percentage points, maybe into the 10 to 20% negative gross margin kind of a range, because at that point you can make that up pretty quickly with very high margin subscriptions. And that's really the business model. It's a razor blade model. You need to get razors, or bikes in this case, in people's hands with this so they will continue paying their monthly subscription. But at the end of the day, they've got to get their supply chain figured out. We've seen a number of changes that management have put into effect. I've started to see bikes at local sporting goods stores, so you can now just take them home with you. I think that's a really interesting way to deliver bikes to customers and get them paying that monthly subscription even sooner. You put a little bit more onus on them, but is that going to be a successful shift to the strategy? I think we're starting to see progress in that direction, but we need to see that continue in the first quarter of 2023. The next and potentially more important question long-term is what happens to subscriber growth? This is a business that really pulled forward a lot of subscribers during the pandemic, but subscribers is what this business is all about. Peloton is going to be nothing if it can't keep those subscribers, keep them paying their monthly fees, and even increase those fees just a little bit over time. So what does subscriber growth look like? We know that it's come down significantly, but is it continuing to tick a little bit higher? If it is, this is a company that can really turn things around relatively quickly, because each of those incremental subscribers is going to be very high margin for the business. It doesn't cost a whole lot of extra money to deliver the software and the streaming services that each new subscriber requires. And even the classes that they're offering are essentially a fixed cost that goes into the business. What does that subscriber trend look like? If it ticks up, the stock is really going to react positively. And if it's ticking lower, then that really spells a lot of trouble for the company. Related to subscribers is what is Peloton's ability to raise prices? We've seen a couple of price increases recently, but that's one of the levers that management has. One of the things that's going to be interesting to compare to is that a lot of in-person studios and gyms are starting to really raise their prices significantly in 2023, partly because of inflation. They have labor costs, they have added costs for borrowing money to buy equipment or increased rents. So they're seeing a lot of cost pressure. Peloton doesn't necessarily have the same cost pressure in its business because it's a technology business and it's able to deliver a class to thousands or even hundreds of thousands of people instead of just a handful of people. But if competitors are raising prices, does that mean that Peloton can do the same? I think it might be the case. And I think that's one of the really bullish things long term. For around $44 a month, Peloton is delivering a lot of value that at a traditional gym is going to cost hundreds of dollars a month. It's a little bit different. You're doing things at home instead of in a group, but that cost number could be really important. So if people are shying away from paying higher and higher fees at their gyms, maybe Peloton is a good option for them, and maybe that helps with churn and with their monthly rate. And the fourth question is about churn, which I just mentioned, and that is how many people are canceling their subscription each month. What you want to see with any sort of subscription business is very low churn, because that means each new customer that comes in is just adding to revenue. It's not necessarily replacing revenue that you're losing from a customer that's leaving. One of the things that has been very encouraging from using Peloton is they have had more and more classes, more and more services to add over time. That makes it easier to pay that monthly fee. If I was just getting biking and maybe some running classes, that would be a little less compelling than having a complete suite of strength solutions and meditation and all kinds of things that they've added over the last couple of years It makes it much more compelling to just stay with the service. Even if I'm only using a couple of these, it can be used by the entire family or the entire household. So are those kind of strategies working to reduce churn? That's the other number that I'm going to look at for Peloton and see how many people are leaving. So really the big things are what's happening with hardware, how quickly are they adding customers, how quickly are they losing customers, and then what does that pricing impact look like? Because what Peloton wants to be is a very high margin software business that's delivering a lot of streaming solutions to millions of people around the world, and that's how it gets to be a profitable business. We aren't quite there yet, but if it starts to show more signs of being on a road to recovery, this could be a stock that does really well over the next few years. What are your thoughts on Peloton? I'd love to hear your comments in the comment section below. Don't forget to subscribe to Rev Investing. Thanks for watching, everybody. I'll see you here next time.